Awesome.
Let's see. Did it actually start the recording? Yes, it did. All right, guys. Thanks for coming back. This is episode, I believe, 18 now. I've got a good buddy of mine, Alex Angus, with us. Alex is a PML and a connector in the community. So, Alex, why don't you just kind of kick us off? Tell us who you are, where you're from, what brought you into the community, and kind of how you got here.
Yeah, for sure. I would say, so I grew up in New York and I came out to Los Angeles. And I've been living in Los Angeles for 10 years. Um, I just realized that, working for someone in my W-2 is not going to get me to the goals. And I started to dabble into real estate and, you know, trying to get that long-term wealth where you can essentially gain money while you sleep. So I joined up with Gator first, just as a lesson into getting funding into business, like technically the easy way to get into real estate. And then I joined SubTo shortly after, and it was a lot about creative financing and getting properties without your own money, and then really without credentials or anything like that.
Yeah, I was gonna say because I met you through Sub too. I wasn't in Gator, so you joined Gator first, and you learned kind of the lending strategies and the connecting strategies before joining Sub two.
Correct.
How was that? Did you start doing deals when you were in Gator before you joined Sub two, or did you kind of wait? Because some people I know wait until they get into Sub two to get that knowledge.
I would say I started with Gator. A lot of it was like EMD, essentially, just learning to connect with wholesalers and lend towards their earnest money. Um, I would say at the time I was also learning about wholesaling, so I did have like a wholesaling company at the time. Um, and then after that, I went into SubTo shortly after.
Nice. Um, what about EMD right now? Do you think it's still as prominent? Because I've noticed since the Gator community has gotten a lot larger, there's a lot of people asking for EMD and double closes that they're willing to fund them, but I haven't seen as many requests for them.
I feel like there's a lot less requests in like single family houses and stuff like that, but in the commercial space, it's definitely needed because you're dealing with like $30,000 in EMD for one like multi-family house. So it makes more sense to do it there than $2,000 here or $3,000 there for earnest money.
Yeah, especially if they're a decent wholesale operation, chances are they're probably just funding their own EMD if the EMD is low enough.
Correct.
So you're seeing more of the EMD right now in like the commercial space.
More lucrative, yes. More lucrative in the commercial space. It makes more sense there.
Like you said, where it's 20, 30, 40, even, more than that, depending on if it's a bigger apartment complex, RV park, warehouse, whatever kind of commercial buildings you see.
Exactly. And that
Nice.
I would say that lent itself into kind of connecting as well. Because as you network within a community, you try to find out what people have and what they need. Then essentially you just kind of bring funds into other people's deals that have money.
Yeah, which makes a lot of sense. I know that's one of the strategies that they teach early on in Gator is connecting, Gator wrestling, that kind of stuff. How
Mhm.
many deals have you done like that?
Um, Quite a few. I'm not sure on the number. I think we have to solidify it, but one of my business partners is there as well. I think collectively we've done maybe 20 plus deals, um, combined.
Yeah, so you guys are getting a lot of funding then.
Essentially, yeah, we just know where to get them, and right now we're focusing on, the first positions, like bringing hard money into these situations, getting people that proper funding, and then we can work into getting a private money lender to get like the 100%.
Nice. So that's has that been y'all's primary strategy since the beginning is finding like a hard money lender for first position and then getting a private money lender to get them closer to that 100% LTV?
Not since the beginning. Now we have our own sources as far as hard money, but typically people will come in saying, "I have a hard money already secured, and I need cash to close." That's like usually the deposit. That's like closing costs, and then sometimes they need like the monthly amounts because you have to pay the hard money lender monthly.
which makes sense. I know every lender is different though. So if I like, let's say I brought you something, I had a hard money lender secured. What kind of criteria are you looking at to get them that gap funding for the rest?
I would say if the criteria would be to really see if there's enough spread, enough room
Hmm.
within the property. Um, and we like to have our lender secured, right? So that means we're bringing a lender in and you're saying that it's going to take 6 months, maybe 2 to 3 months to rehab it and another 2 months to sell.
Hmm.
We're looking at like days on market to make sure that's right. So, I mean, you're bringing us all the numbers and then we're just making sure that everything is right.
Yeah, because I know a lot of lenders are looking for the borrower to at least have some level of skin in the game. Do you guys have some kind of way that you guys work that out?
It, I would say right now it's more like monthly payments make you feel better about the deal.
Hmm.
Um, so that's, as we're bringing in the funds, we know that you're paying the lender, the hard money lender, the first position, and you're also paying the second position monthly, just so, that's what it is, the skin in the game.
And what about in that second position, you said that you had to make sure it's secure. Can you walk us through like again, like hypothetically, I have a building, we have hard money secured. What are you looking for collateral in the second position to make sure that your lenders are secure?
And like you said, every lender is different. If you have collateral, we typically like to have, so if you have like, if you were requesting 40K, for instance, we like to have uh, double the amount of equity. So if you have another property that's like 80K that's available, um, that will make a lender feel secure to know that, if something will happen and you need to foreclose, then they can get their money back.
Yeah, so and the reason, guys, that he looks for that double is because, right, if by any means I decide to default on the loan or I default on the loan at even if it's not my fault, either way, if he has to go and foreclose on that, he has to not only be able to take the interest but take any kind of late payments and penalties. Is that right, Alex?
It's part of it, but it's also if you're in second position, which makes it more risky, is the fact that the first position will always get paid first.
Hmm.
And that's why we said we have to have room. So that means the second position can also get their funds. So that's why typically collateral is needed. So, uh, they have opportunity to at least get their money back from some other property.
And do most of your lenders require a personal guarantee too? They're just basic stuff like background check, maybe and collateral.
Personal guarantee is always, it makes you feel more secure. Like me as a lender, I understand it a lot more now too. Like if I'm lending, it's like, yeah, you're personally guaranteeing it. That means that you're confident in your own deal, right? Like you'll you'll make sure that we get paid back, and yeah, that's typically what we like to look for.
Yeah, you're looking for the borrowers that are confident in their deal. They stand by it. They know their numbers. And I'm guessing too that it's probably underwritten well because I do see that a lot. I see the pitch decks are, we'll say, sometimes supported by flimsy numbers at best.
Right.
You see that a lot too. A lot of like guesstimates, like, oh well, we have this pad split that's gonna be 10 bedrooms, but it's only gonna be $150 a month in water. Like, dude, in what world? Like, what
We haven't
municipality
actually,
is that? Tell me, you know?
yeah, I don't know how that would work. Well, I mean, if they have simply just two bathrooms and they're just trying to break out the bedrooms, then it's possible, depending on the area. But no, we haven't dug into that. Um, just knowing their monthly expenditures and the utilities, like that's not something we did, and it's typically not buy and holds that we bring in for. It's more so that we know that the exit strategy is going to be quick. Um, it could be a buy and hold though, and they have refinancing set up, and we can also set that up too.
Yeah, that's true. I did forget y'all. You were telling me right before we started the recording that you guys focus more on the flips, which is obviously shorter terms than buy and holds and even refis.
Correct.
You guys have any particular markets y'all are focusing on right now?
Not necessarily. We do want to get back into like the, I want to say more landlord friendly states, more states that that are more usury friendly.
I wasn't sure
But
if
I would
you,
say like California and New York is still one of those places that's definitely hard to lend in. So we're not doing those.
yeah, California, New York, probably. I think New Jersey and Illinois are up there too, as far as like states that you probably should stay away from, whether you're an investor or a lender.
Yeah, we actually have a lot going on in Illinois. So yeah, we've lent to quite a few on one particular Clippers deals out there. So it hasn't been bad. Chicago in particular, yeah.
What are y'all lending on for four flips? Y'all doing like 80 to 90% LTV?
It would depend on the hard money,
Mm-hmm.
depend on what's already there in place. If you said full flips, like you take the first position.
Mm-hmm. Yeah, if you're doing first position, would you guys where would you guys fall at typically?
I guess that will vary based on the lender too. Um, we're still like 70% because that makes it secure, and a lot of lenders do like that. But if you have collateral, we can go up.
That makes sense. And for those people that are wondering, can you break that down a little bit? So how do you calculate your LTV when you're looking at it? Because I get asked that a lot. So I usually ask my PMLs to break it down for them again.
Honestly, I'm still working on understanding LTV fully, but I mean, we have a calculator for the most part. It's loan to value. So if the as is property is worth, the $100,000, then typically they want to lend a maximum of $70,000 to it. So 70% LTV.
What about and LTV is usually calculated off of some percentage of the ARV too, right? Like I know a lot of lenders won't go say above 80% of the what they call the true ARV, which might be like what they're requesting plus the rehab budget.
That, like I said, that varies on the lender because some lenders only want to do as is value. That means, if in the middle of their doing a flip and they run out of money or something, or something happens, like they need to sell it now, not where it's sold at the ARV at the completion. So that's why they want to make sure they're secure there.
Yeah, that makes plenty of sense. So then what what other kind of stuff are y'all seeing as far as like borrowers? Are you guys seeing like what kind of red flags, green flags do y'all see in that space right now?
Red flags for our borrowers. We typically like to work with people that have experience, that's shown that they know how to exit and they know how to pay people back. Um, we've tried to bring in like newer borrowers, but that would mean like we're trying to bring in like the hard money lender for themselves. Um, and I don't know if I can answer what the red flags are. I mean, if the background check doesn't work, if they have issues with financing before and they haven't paid people back, those are definitely red flags.
Any other kind of soft characteristics? Because I find a lot of people are just difficult to work with in general. Like they're slow to respond, or they're not always the most forthcoming.
I would say communication. I always boast everything. Like if you're quick to get everything that you need and you're communicating and if you're down to give updates every time, then that's something that we always look for. And yeah, if you're hard to work with in the beginning, you're going to be hard to work with at the end. So those are the things definitely to look out.
Yeah, I could definitely see that. We've noticed that just in the people that we raise for, the ones that are difficult in the beginning are always difficult at the end. If they're combative now, they're going to be combative later. And if they're combative later, you know, God help you when they actually get somebody else's money.
Right. The fact that if they're bringing up issues when they're asking for money, like they're at full need, then they're probably going to have issues trying to give back the money. and that's not something we want, especially if something like goes wrong on their end. Like, I mean, these people's money is hard-earned money that they had, and they're sharing with other people to, help them progress in their project. So communication always boosts.
Yeah, that was the whole reason that we started this video podcast series, was just because people weren't aware of how to network appropriately and also communication. So that's why I've tried to bring in other PMLs and, other connectors and capital raisers and TCs, so that way we can explain to people like, look, whether whether you're in good standing or you're not in good standing with somebody, like, this is how you communicate and this is how you work your way through it. You've networked through the community too. So I imagine that you've met a lot of people and seen a lot of different personalities and interacted with with many of them.
Yes, absolutely. Yeah, typically, I mean, if someone could say that they've done their homework, and able to communicate that, and they're able to say what their goals are, and then how you could, um, benefit from them actually working. Like if you're out there networking, you typically want to find out what the other person wants, right? To see how you can benefit them. I would say that would be, better results as far as building that relationship.
Yeah, definitely. You definitely get much better results if you do your homework and you actually come prepared. Um, like I said, we see that a lot. A lot of people are unprepared and with their pitch decks, with just even meeting with the lenders in general. They get asked sometimes basic questions and have to go back and look it up. Um, is there anything else that you see like
Right.
that where people tend to kind of fumble?
I would say, yeah. I mean, that's part of our problem too, even as connectors. Like we want to try to get all the information upfront so that when we are able to bring it to a lender, like we have the answers for it. So that's how some things don't get funded as connectors, because you haven't been able to answer everything.
Yeah. How do you guys do that? Do y'all build the pitch decks for them, or do you guys just take the pitch deck in and review the deal and go through it before you present it to your lenders?
We typically build the pitch decks for them. So, we break out a form, we ask all the questions in the property, and then we even like pull the pictures. So we ask you for pictures of the property as it is now. We ask you for like the scope of work to see what it is as far as you getting the rehab. Um, and we'll even ask for the contractors like information too, so we can talk with them, make sure that they're competent. I mean, it works both ways. Like as we're coming in, we're also helping you as an investor to make sure that you have your contractors and everything, your ducks in a row, and that's how we bring our value to both the lender and to the investor as well.
And one of the other things I had come up on one of my last PML Zooms that we did, do you as connectors get paid out of the front end of the deal or out of the back end of the deal when the lender collects all their money?
I would say it's based on the negotiation. It's based on the way the deal is going to be structured. If there's room on both ends, then maybe we can work it out that way. Um, and then we don't have a an official commission structure yet. We're not necessarily. I mean, as a broker, if we're doing brokering hard money, then just definitely at the front, and we do have something commission based in that way. But for private money, it's all negotiation.
Yeah, I wasn't sure because I've been hearing that more PMLs are trying to move towards, if there is a connector on the deal, that the connector gets paid on the backside once the term is up. And that's also why PMLs are moving to shorter terms as well, because it's less time for things to go wrong and less cleanup if there has to be.
I can see that. Um, and yeah, as I would say, as we're trying to move into acquisitions ourselves, I think it's been a difficult struggle with getting PMLs to do longer term. It does make sense for the folks that have something like a 401k or something like that to pay them interest only, but that
Yeah.
doesn't work too well like fix and flips. It works.
Yeah, well, fix and flips, you probably shouldn't be, taking money for more than 6 months. So it makes sense to keep it in the shorter term. Although I do also see people in the fix and flip space grossly underestimate their own rehab time. And that we had one recently, it wasn't a flip, it was a buy and hold, but the rehab time was like 2 weeks. Like, no, dude, this is gonna, like, you're trying to add bedrooms. This is gonna take 45 days at least.
as a minimum. Yeah. The only thing that can really work like that is like a hotel. You just, taking a property, cleaning it up, and putting it back on the market. And
Sort of like
sometimes if it's
innovation.
already clean, and you can just take it and put it out there. It could work too.
Yeah, sort of like innovation
Yeah.
almost.
Well, novations could it could be rehab. Novations are more like you're partnering with the seller, and you're saying, hey, we're not gonna transfer anything really. Maybe just the deed in our name, but we're gonna stay there. Um, and then we sell it, and then you get a portion of the profit from there. That's more innovations.
Yeah, because my buddy Tyler, who's in here, I think he's done a couple innovations, and he was saying that some of the best ones that he's enjoyed the most um have been the ones that are super light rehab and don't actually require like don't require a lot of heavy rehab.
Yeah, those make sense. It's a shorter time frame. You don't have to do a lot. You just probably do some paint and some light touching up in some areas, and then you can put it back on the market, and that benefits everyone.
Yeah, that's one of the things that he said worked really well for him was there was a few property that they had to do like some major cleanup and probably some landscaping and some paint, but that those were easier innovations because it was just like finding a dresser off marketplace that you get for free. You clean it up, maybe restain it, and then you just list it again
Exactly. Those are very nice flips.
when you can find them. It doesn't seem like those are the easiest ones to find though.
Yeah, I don't exactly know how to find those.
I think if we did, there'd be far less of them. There's already not enough. But I think if
Maybe
they,
like low equity deals.
you know, I'm not sure. Like I said, I have to ask him. Which Tyler, if you're still in here, feel free to chime in because because like I said, he's done a couple. I know he's done um, I don't see him. He might have hopped out for a second, or he might be on mute. But yeah, I'll try to get him to hop in here at some point, and we'll talk about innovations a little bit because he said he's done one or two down by him. Um, what kind of buy and hold stuff are y'all funding right now, if any? Because I know you said, like you said, you were focusing mostly on the flip side, but are you guys doing any buy and hold lens?
Not necessarily for private money. If it's gonna be for buying holes, I mean, we can get you some good like DSCR rate, um, and that's what we have as a product right now.
What's the SCR interest looking like right now?
I'm not sure.
Because I've heard a range. Like I've heard some people have DSCR lenders that'll allow for a second position. I've heard some that will have interest rates as low as I think 4, 5.5 is to and up to about 8, 8.5 or 9.
Yeah, I would say from what I've seen, it's around like 8%, like on average.
Which still isn't terrible, but I guess for people that don't know, can you explain what the debt service coverage ratio product does for, potential investors?
I mean, DSCR is you have an income producing project, and essentially you can do like a cash out refinance, and they refinance based on the income of the property. I don't know if I'm explaining that right, but essentially they're giving you money, um, so you can continue making it happen, and you're still getting income. You're paying off the lender, and then you're also um, getting a profit as well.
I mean, that's kind of how I've understood it too, is that that DSCR payment will both like expand and contract. Like if you have vacancies, there's a chance, that you might be able to pay a little bit less for a month or two while you have that vacancy as opposed to when you're fully occupied.
Those are good lenders to have. That makes it a little more flexible.
That and they're usually not full doc loans either. Is that right? With what y'all do?
That depends. I know a lot of DSCR lenders actually still need your credit score. Some do just asset based, where it's just that the asset, but because you're the owner, they do want to make sure that you're responsible.
That makes sense. But I would say DSCR in general is still easier to get than most other loan products right now. Like, wouldn't you say so?
I would say so. Typically, if you have a lease in place and you're really just showing that your property is gaining income, then a lot of lenders would be more favorable to give you your terms based on that.
And what kind of financial docs do they look for to kind of, I guess, corroborate that story? Would that be like just your typical T12s, rent rules, maybe a balance sheet if required?
Typically like a lease agreement, and then maybe a month or two of payments, successful payments, just showing in a bank account that is still happening there.
Yeah, just showing that you're actually receiving the money and it's not just a lease.
Exactly.
Yeah, because I know a lot of people go to DSCR for all kinds of things, whether it's for commercial or even rather big portfolios. Because there's not really like a limit to how many DSCR loans you can get, right? Not in the same way like a traditional mortgage, they usually will kind of they'll throttle you on how many loan products you can get.
Correct. Yeah, you can have as many properties as you can. And I mean, for the most part, you can do so the same one.
Yeah, so it sounds like it really kind of gives that investor more flexibility. And like you said, same thing with DSCRs with private money, right? Like every lender is different. So if you get a term sheet you don't like, well, just go to another DSCR lender.
Exactly.
Um, by the way, you and I had talked before about you had some loans that were out that were coming back late. I was going to ask you about that. Like, what are some of those pitfalls that newer lenders should be looking for?
I would say some of the first things that we did wrong when we were just lending is sometimes you just trust the lender and send them money directly and just kind of write up a document, a promissory note. I would always recommend to use a title company, never just send it to the lender. Um, I know it does cost a little bit more money, but they pretty much make sure that everything is in place so that you get your money back. Um, and that's you typically do need four documents as a lender. And I would say one is a promissory note, the other is like a security instrument, which means like a lien toward the property to make sure that it shows up that you're in the position that you need to be in.
Mhm.
The other is like a lender's insurance policy. So if the house burns down, then it's going towards you. That's like more homeowners, but then the lender's title policy is like if the title company did something wrong, then they make sure that they can pay you out as well. Those are the four documents.
And what kind of private money rates are you guys seeing right now in the communities? Because I know, like we were saying earlier, the terms are getting a little bit more strict. I think as people are, coming due late, so we know that the time frames are compressing from probably like 12 months to 9, really more like 6 months. What about the interest rates? What have you guys been seeing?
I would say it also depends on the position. I think second position is typically around like 20%, and that's looking at like a 6 month term. I know some people do like 4% a month, like 4 to 5% a month or so like that. Um, and then if it's first position, it's around like 14% roughly in the private money world.
Which I mean, that's not too bad for first, at least. That's about what you'd get on hard money in most cases anyway, right?
Their hard money is a little bit less, but they do require more documents, and you need to show your credit score and everything like that. So it makes sense there.
Yeah. Well, and I think that's what people don't always understand either, right? Is like when they're going private versus going institutional, a lot of times you are paying for that speed and that convenience of not if the lender has to make that snap judgment off of something that's not a full doc loan. So they don't have all the same information that the institutions have.
Correct. Yeah. The typically the lenders just want to make sure that experience shows that you can exit and pay them back, and they just want the security and knowing that they're going to get back their money.
What kind of stuff do y'all look for in order as far as experience goes?
Um, HUDs. So I mean, HUDs are just like a receipt of your work to show what you bought the property for, and then what you sold it as, and that shows you're making good money, you're making a good spread, and you know what you're doing.
And what about for like the newer people that are coming in, right? Maybe they have all the knowledge, maybe they're a contractor, but they're still looking to flip their first homes. What kind of stuff can they do to kind of provide confidence to that lender in lieu of having, a ton of experience?
A lot of times with our new investors, they're actually bringing in someone as a partner to show the experience. So, I mean, typically we want to look at the property to make sure that they're buying it correctly. Typically it's like under 70% LTV, maybe even less if they can. And, you have a contractor in place that, we want to tell you to ask for three bids or so, three different bids from each contractor to make sure that this all lines up. So those are the kind of advice that we give them. But typically, bringing in a partner with the experience is the most helpful thing to you.
Yeah, I think people grossly underestimate that. It's far more common in the commercial space than in the single family space to have what they call an experienced partner or an experienced sponsor, kind of similar to like if you didn't have the money to qualify for a loan, you get a credit sponsor. Um, I think that's been far undervalued. So I'm glad you kind of touched on that. Um, so you're saying that's probably the most beneficial thing that most people can do if they don't have the experience is to get that kind of that partner or that sponsor to come in.
That's correct.
So then how many HUDs and stuff like how much experience are you typically looking for that partner to have? So I know you said that they had to have some HUDs. Did they have to have like say 5 in the last year or 10 in the last year?
I know a lot of lenders need typically five to show that you're still actively doing it within the last 2 years or so. Um, three is okay, but five shows that you still understand the market as it's being changed, right? Because the market changes is definitely an issue, like interest rates going up and down, and people not buying at the same rate and prices that they used to.
So roughly 5 over 24 months or so.
Correct.
That's not too bad. I know that some people, especially for volume, they want I think 10 and 12 months, which is intense, but that again, that's people that are applying for volume funding, like get funded in like 5 days or less sometimes.
Right.
Y'all don't typically tend to do volume, huh? You just do more like we were saying, like more one-offs with hard money and PMLs.
No, we're working with hard money. Typically, we like to work with people that want to scale. That means that they're already doing job. they got money in one project, and instead of like waiting for it to sell to roll it over into another project, and they're still getting deals. Like we're able to deploy capital into this next project, and they probably have three more lined up. So that's what we like to work with.
Yeah, so y'all like to catch them on the way up as they're scaling.
Correct.
So then how does that work then, I guess, for y'all? Is there any kind of cadence to that? Because I know, obviously you want to make sure that the lenders on the project that they have that's ongoing gets paid, but you also want to make sure that you get paid.
Correct. So I mean, there's different ways to do it. We can ask for a little bit more uh, above what they're asking for the project, and this
Mhm.
way they can pay everyone out, or we can do it like by points via brokers, like broker points, something like that. But either way, it's flexibility and however it's done.
And with them having that many projects, are you guys cross collateralizing if they have too much going on at one point or another? Because right, like the as is value is going to be really low if it's under construction at that time.
Correct. So yeah, cross collateral makes a lot of lenders feel more secure.
Probably, especially with cross collateral, I imagine would make them feel more secure, especially when somebody's moving that fast.
Exactly. Yeah, we have investors that can do maybe 7 to 10 at a time, and yeah, I mean it looks appealing that you're able to make it happen that way, but it's also concerning to say like, yeah, what if something happens? Like, how can you do it? So liquidity always comes into factor to make sure that you have funds in case something goes wrong, but you also have funds in case you need to pay a lender early or something if something else happens.
What kind of liquidity requirements are you guys seeing in the market right now too? Is there any, can you kind of give us a little bit of an idea or a ballpark?
Especially for hard money lenders, if they want to see that you can make payments for 6 months. So whatever it comes up to that, their monthly payments, they want to see that you have 6 months of payments typically. I would say that probably aligns with PMLs too.
That makes sense. So they should have probably roughly 6 months worth of liquidity for the payments. Um, and I imagine too, we talked about LTV earlier, that LTV would also go up if they have more experience like that, if they're doing good and they're scaling.
Correct.
Because you said you guys do a lot more in like the 70 range. Um, have you worked with people that are in that higher range as far as like more projects, like 90% LTV?
Yeah, if you have like 10 plus deals, then yeah, we definitely have lenders that can do, closer to 90.
Yeah, I think I've had we had a few requests to find somebody for 100, and I was like, bro, you're good luck. Good luck, and if you find them, it ain't cheap.
Yeah, we do have 100%, but like everything has to fit under 70%. So your rehab, your cash to close, the purchase price. If it fits under 70%, then yeah, they can fund 100% of it.
Right. So in that case, they'd probably have to buy it for like say 45 cents on the dollar. So that way they had enough room that, like you said, the rehab and closing costs can all fit under that 70 cents on the dollar mark.
Correct. Exactly.
Because like I said, doesn't it start getting expensive when they start asking for 100% LTV since the lender's taking on more risk and it's not, I guess that borrower no longer has as much skin in the game as they would typically.
Yes, but that also is the reason why they ask for experience. They understand that all you're trying to do right now at this point is scale. Like you've proven that you can do it. Um, there's less risk involved because I mean the worst that can happen is probably like the house burning down or something randomly. But you've done it enough times where you're showing that you can make it happen, and you just need that financial partnership to grow.
Yeah, that's fair. Like you said, a lot of people they sometimes they have the experience, sometimes they don't. But more often than not, that is the piece that they're missing is the capital. And so if they can demonstrate to you that they're responsible and they're good, you can bring the capital and then they can scale.
Exactly. You summarized that nicely.
I try to. I mean, we have to have a lot of the same conversations that y'all have to have, right? It's like we get stuff brought to us all the time. And when a lot of times they will do their own pitch decks, which is why we're moving towards like you're saying, like, hey, we're gonna send you a form. I want you to fill this out. We're gonna build the pitch deck for you. Because the last deck I got to review, it didn't have the city, state, or zip code in it. So tell me how I'm gonna underwrite your property when I don't have your city, state, or zip.
Yeah, it's like they might as well not give you the address. Like,
Right, because that 123 Main Street could be in any state in the country.
correct. Yeah, that's crazy.
Oh, dude, I've seen it all. I've seen some that were missing purchase price and ARV, which is also among the first questions that lenders ask. Um,
Yes.
let's see. I see a lot where they're more worried about the images and the text overlay, which is funny because they don't know anything about Photoshop. So then they put like a white text over like an image with light in it, and then you can't read the text.
Yeah. So it's
Uh,
good to build your own so you're able to display it correctly.
Yeah, well, it's also like I said, it's also good to trust the people that you're engaging to help broker the deal for you, right? Like that they should probably come to you and say, "Hey, Alex, I was thinking about building my own deck. What would you want to see on it?"
Yeah, exactly. I mean, it's a collaborative effort either way.
Because I don't know about you, but I would say that the simpler decks always win. The ones that look like they're built by a third grader, as long as the information is there and it's concise and it's easy to read and understand, those are the ones that always, always, always beat out the super clean images and the gradient backgrounds and the transitions and the whatever.
Correct. I'm noticing, yeah, if, like Canva decks are great. Like you can do that with everything, but like the ones that get funded most are the ones with just a straight Google Doc and links to the project.
Yeah. The ones that we've had the most success with have been that they've been Google Slides and they're nothing fancy. They're 8 to 12. Just tell us a little bit about you, tell us a little bit about your experience, tell us a little bit about the property, the comps, and if it's a specific exit strategy, a little bit about the underwriting that talks about that exit strategy.
Right.
So like one of the last ones that I built, was for co-living. So one of the things that the borrower put in there was snapshots of the map to show how close it was to, different things that would make it a good co-living, like the colleges, the the hospitals, the bus routes.
Yep. Airports if it's nearby.
Yeah, so you said, like I said, you guys don't fund a lot of those, huh? Y'all stay more on the fix and flip side. Because have
That's,
you funded any co-livings lately?
no, we haven't, but we're actually looking into getting into acquisitions to do our own co-living.
Nice. They can be a little bit tricky to get funding for sometimes. I think just because you're buying, holding, you're also a lot of times doing value add or rehab or both. And it's a multifamily, it's not a multifamily. So I know one person like Cassandra was gonna be here, um, and she couldn't make it, but I know she struggled for a while um to get refied out of her PML loan on her co-living, but could also just be because it's Alaska. There's only like 6 people that live there anyway.
Yeah, I've never done one in Alaska, so I can see how that would be troublesome.
So I guess talk about acquisitions though. You said you're transitioning into it. What kind of things are y'all looking at doing? And I guess it works out good for you, right? You spent the time to build that network. You have those lending connections that should make taking down properties a little bit easier.
It does, but we have only really secured like short-term lending. So the only option that we could probably do is maybe, because some people's maximums are 6 months, and if we need 12 months, we can refinance every 6 months or so. But because a lot of our lenders are in the gator community, the money is actually a little expensive.
It can definitely get very expensive sometimes. Are you guys looking outside the communities at all for money right now?
We are going to bolster more into outside the community, yeah. So even family and friends, but just typically people that have like, 401ks or IRAs just sitting there not making money, losing money, or just making minimum returns. Those are those are the people we're typically looking for.
Yeah, that's one of the things. I have a meeting tomorrow with an old friend from like grammar school, and that's what we're going to talk about is how we can get him and his clients into some private placements, so that way they can outpace like the S&P.
Exactly.
Because when you do go
Yeah,
outside the communities, most of those people, they are, like you said, they're only getting 4% if they're primarily in bonds, which usually younger people are. They might be getting 6 to 8% depending on how their stock portfolio is laid out, or they could be getting, you know, 12% maybe on a good year, the S&P or ETFs.
and that's a maybe.
Yeah, exactly. It's a pretty big maybe, especially right in an election year. What's up, Ron? What you got, brother?
You guys hear me?
Yeah, we got you.
Perfect. Thanks, guys. Just a quick question. You had touched over a little bit about what you're looking for in a deal deck, as far as the pertinent information to present. How many slides should it typically be? Does it matter? Should it be two or three, as long as all the information you're looking for fits on the deal deck?
I would say as long as all the information fits there, it could really be 2 slides. Typically, is as much as you need, and just like links to pictures, links to the scope of work, the project, like a link to the first position, that hard money lender, if we're looking at like a fix and flip,
So, like
and
for
just
gap funding,
like
you
you
mean?
said, for gap funding. Yeah,
Cool.
So, Ron, my rule of thumb with pitch decks is it's just like dating a girl. One date's too short, 9 years is too long. So, you want to kind of keep it like short and sweet, kind of in that middle ground where you feel like you're giving enough information, but you're not overloading them. Like we were saying, a lot of the decks that I've built, and it sounds like what Alex has built as well, are typically, I'd say mine are usually 8 to 12 slides, and that's a little bit about you. So it's probably a slide about the like a it's a title slide, a slide about you, a slide about your experience, a slide about the property, a slide about the ask, a slide about the execution strategy, aka the exit strategy, and then a slide about the returns and a slide about how you're going to pay them back. And then any backup plans, if you have backup plans, like we usually will mention if because they will underwrite them for more than one exit strategy. So like this is what it looks like. If co-living doesn't work out because there's an HOA, we'll roll into MTR or LTR because we know that we can still do that and succeed even under an HOA. Does that make sense?
Totally, yes. Thank you.
Cool, man. Did that answer it?
Yeah.
Awesome.
well, did Ron have anything that he's working on now?
I don't know. That's a good question, Ron. You got any properties you're working on at the moment?
Yeah, I am actually working on a um basically cosmetic rehab for a townhouse in Tempe, Arizona. And uh it's a weird deal. It's going through probate right now, so we're just waiting for the court to basically sign off on the sale purchase, and then we can move forward. This was supposed to be done in earlier this month, but the title office just told us like, oh, probably won't happen till mid-August. So obviously that's pushing our timelines out. And uh, I'm joint venturing with a partner in this that's been an investor longer than I have. I'm still fairly new and just basically in my rookie year, business startup and so forth. So we're going through a hard money lender for the bulk of the funding. We we're looking at private money lenders for the rehab cost, which is about 45,000. So he, since I'm the one that's fronting most of the money out of pocket, my skin in the game, he was supposed to like do all the legwork and so forth that find the private money lenders for the rehab costs. And I was hoping to find something on my own for gap funding, which is they're wanting 70 grand for it. So yeah, so this came up in the JJ's group. So this is why I was just super interested to hear all your takes on it. And I did pitch my deal, just like a little one pager Canva in the group some last week, I think. So this is why I had asked that question. Well, how big did the deck need to be? So because I'm probably missing out on some other additional information.
No, the
Yeah.
one pages are great for just introducing the deal, right? Just to show the numbers and how much you bought it at and what's the potential with the ARV, and you should also include like the profit splits that it could be and what the lender can possibly make on it too.
Yeah. I
Oh yeah.
usually my one pager is usually like the elevator pitch, so to speak, and that's like the post that I would make if I were like, let's say I went into JJ's group and I was like, hey, I'm looking for lenders. It's going to be second position in this market. Um, this is the purchase price. This is the ARV. This is the hold time. This is the interest rate that we propose, or profit share if we're looking for a partner. Um, Kind of just covering the basics, like I said, kind of the nitty gritty details that we would ask like in a form. That's
Mhm.
usually what I do with one pagers, because a lot of people will make one pagers, and again, they'll try to make them elaborate. The last one pager I got, it was kind of everything. There was so much info on one page, it was scrunched, and it made it difficult to read. So as long as it's legible and it's easy to comprehend and understand, like, yeah, dude, one pagers are fine.
If you, I could send it to you directly, and Adam, and just I would love your feedback on it. Just tear it apart if you need to. I'm all up for some good constructive feedback.
Is the deal funded already?
So the hard money loan, I think, expired because they only gave us 2 weeks to sign everything, and since title said, "Oh, the courts will figure we'll have a decision by mid-August." That's I don't know where it's at right now. So I'm having a strategy call tomorrow with my business partner to see where things are at.
So these are
So
recorded and they go on YouTube, but if you want to take a moment and like block out any address or anything that you think might be personal, I've opened it up so you can share the screen and we'll take a look at it.
cool. Thank you.
Yeah. Yeah, take your time and then just, let me know when you get it and we'll pull it up. We did a deal break that down like that on the last PML Zoom that we did. And it ended up being really cool because we got the chance to, for him to give the feedback live so you can get a better idea of what PMLs and what connectors and capital raisers are looking for.
And I heard you say your hard money lender expired. So, I mean, if you're interested, I can share some hard money lenders I have as well. We typically like to look for hard money lenders that allow seconds. Like we like to be open with them and let them know that, somebody may be coming in to bring the cash to close or that gap
Mhm.
funding.
Yeah, thank you guys. I appreciate it. I'm trying to find that info.
Yeah, man, of course. Like I said, anything we can do to help, that's why we do these is and that's why I try to bring in a multitude of guests. Like next week, we're going to take a break from the PMLs. We're going to do an integrator Zoom with actually one of my partners on my integrator team. but we try to bring a multitude of perspectives, whether it's TCs or capital raisers or connectors or PMLs or PMPs or people that are fund managers, like whatever it is. In the meantime, Alex, is that something that you guys have been thinking about doing, is going that direction and like getting a fund, or are you guys not planning on lending anymore, more just like brokering?
Well, we still need funds, I think. So either if we're doing acquisitions, the two things that anyone needs in real estate is money and deals. So we have been looking at funds and seeing what that looks like as an option. But we have been trying to uh, build up the other side of the company in acquisitions to get that, the mailbox money that we essentially came for in SubTo.
Fair enough. And that's one of the things we were talking about was your acquisitions. What kind of strategies are you guys looking to employ for first? Because we talked about it a little bit before the recording. You were talking about pad splits and any other exit strategies that you guys really like.
I do like, I mean, midterm rentals, we always look at as an exit strategy.
Mm-hmm.
It really depends. I mean, we always look at short-term rentals, but I know that the market is varying with that. But as long as it's showing that there's a potential in there, we definitely look at it. But we do like the co-living models and Section 8. So affordable housing is where we're trying to move into and provide that for, like, create impact for communities, but
I
also
mean,
maximize the potential of our properties.
it makes sense as housing prices go up. That means it's going to be harder and harder to fit within that 1% rule, which means if it doesn't cash flow LTR, you have to get creative. And I think affordable housing is about as creative as it gets between whether you are doing co-living, sober living, or Section 8. It allows you to rent whether you're renting by the bedroom or by the bed, even in sober living, and bring your cash flow numbers up high enough that the 1% rule becomes irrelevant.
Exactly. Yeah. As you know, creative financing, the name of the game is cash flow. I mean, it brings a lot more benefits, appreciation, depreciation, but cash flow is why we're in it.
What kind of numbers y'all trying to hit as y'all are launching your acquisitions team?
Um, I won't say our first goal is just 5K a month passively, but we are trying to level into 100K a month within 2 years, I think is possible.
Yeah, I could see it, especially if that 5K is like if that's your net, then you'll be able to get to 100K gross and then eventually work your way into 100K net pretty quickly if you can get down a template that you can just go out and find houses that fit this buy box.
Exactly. So right now our team is we're interviewing for our operations manager just to kind of build our foundation. And then we're going to start putting out some posts and networking with more agents to bring some more leads to underwrite and secure.
Are y'all going through Jesse Stanton's cohort right now?
Very similar. So yeah, I went down in Vegas and pretty much I'm following, his process.
That's what I thought, because I like every single other person I know that's involved with him right now, they're all like, yeah, I'm looking for an ops
Mhm.
manager.
Yep. And
Like,
truthfully, that's why I started going back into SubTo teachings. That's actually what Pace had taught. That that's really what pivoted his business and started developing it quite a lot. It's like if I could do it again, that's what I would do.
hey Ron, I got the address. Do you have your deck ready that you want to show us?
Yeah, give me a sec to find it.
Yeah, well, Alex, I was gonna say it's just like when he gave them the homework to network with connectors and capital raisers and PMLs and PMPs. I think all of a sudden that
Mhm.
week I had like 6 or 7 new calendar events.
That makes sense. That definitely makes sense. No, I'm not directly in his cohorts, but listening and learning from them as well.
Yeah,
We're
they're
going
all
in the same direction.
they're all good dudes over there. We were just talking about that the other day, because I was in Jessa Roberts' Deal Dragon Zoom, and we were talking about that because a lot of them that are getting started, they are trying to go fast, which most people do. But right, like one of the reasons why they wouldn't be a good fit for Jessa is she does volume funding, so that means that she's looking for experience, and a lot of those guys don't have the experience, but they do have experienced partners, but then they don't have collateral.
Yeah.
So it's just going down that checklist and making sure, right, that like if you're gonna fit this box for this lender, you have to check all the boxes. You can't just check one or two. You have to check all three or four or five, whatever they have.
Right.
Got it ready.
I like what Jess is doing too. I think she's doing mostly Section 8 on their side as far as their acquisition.
They're doing a lot. She just bought a med spa like a week ago. So to be honest with you, I don't even know what that girl's doing.
Buying businesses, doing acquisitions on housing,
Hey Ron,
and
if it's
also
ready,
doing project.
you can either share it in the chat, or you can share your screen. I opened it up so you can share screen.
You guys see?
Yeah.
Yeah.
Alex, what are your first thoughts?
My first thoughts is I like it. It shows quick pictures of the property. It shows the bed, bath, square footage, the amount needed, the purchase price, and ARV. So it looks like there's some decent spread there. And you said 4 months. Yeah, I would also have just a link for additional information.
Maybe like a drive folder that might have any additional docs or pictures or what have you.
Correct.
Yeah, I could see that. That's pretty common, especially if you have it in a PDF like this where you can email it. A lot of people will just put like that drive link, like maybe in between where the rehab budget is and right above the phone number. That way they can just click it and it'll take them to anything else that you have that helps support your case.
Exactly. And you said for this one, the close of escrow is around August. I guess you're not even the close of escrow, right? You have to wait till the courts decide.
That's correct.
And you said you had a hard money loan in place, but that offer expired because the courts are taking too long.
Correct.
The only thing I would say, I mean, as an investor, I understand you want to keep the money cheap. So 12% return works. It probably just works for what you want. But if you're talking about like in the Gator community, like there's people that are ready to do 4 months, but I think they want a lot more as far as return.
Mm-hmm.
And I think you're right at a good spot too. I just calculated it. So by adding, if you add the purchase and the rehab together, divided by the ARV, multiply that by 100, you come out to about 80.46, which is right at like 80% of that like quote unquote true ARV that we were talking about earlier. And a lot of people will do that. You usually don't want to go too far above 80 if you can help it. But at 80, you've got a decent enough spread, and I find that's where a lot of people go wrong is they might buy a house like this, but let's say instead of 45 you need 80. Well, if you need 80 for the rehab, that's going to start bringing you into that like 83% range, and then that's where it gets difficult to find lending for it. And you're either going to have to provide more, you're either going to have to pay the difference, pay that 3 points, or you're going to have to provide additional collateral to make the lender feel secure. because a lot of people, what they underestimate is they'll lock up a house that's roughly in this range, right? They'll lock it up in the 400s, ARV somewhere in the 600s, and they think there's this huge spread. But the difference is the square footage would be like, say, twice the size. It'd be a 5,000 square foot house or something insane. And yeah, while it might only need like floors, fixtures, and light and paint, guess what? Floors, fixtures, and paint might be worth what, $30 a square foot, all said and done. That's not bad. But now you still gotta go back and multiply that by 5,000,
Mhm.
and that's what drives people's
Yeah.
rehab budgets up.
Yeah.
So I think you did good. I think it's a good size house. It's not too big. It's not too small. How much you need is clear. Kind of like Alex said, 12% used to be pretty standard. You can find it. You probably will have a better time finding it in JJ's community because he has people
Mhm.
from all different real estate communities and not just Gator.
Right.
Um,
Yep.
Purchase looks good, rehab looks good. So 45 for rehab means that it's probably relatively turnkey, I imagine.
Pretty much. The only thing major that's going to be redone is the flooring, because if you can look at it, very original flooring. This place was built in 1984,
Mm,
and what I like about it is each bedroom has its own ensuite, and there's a balcony that's outside the smaller of the two bedrooms. I mean, the master has a Jack and Jill balcony versus the other bedroom has like a nice full covered walkout balcony, which is what you see in front that's over the garage on that big picture. That's the
mm,
walkout balcony for the second bedroom.
nice. Yeah, man, I think you did good with it. I would just wait till it gets closer to coming out of the court system and probate, and then just get yourself another hard money loan secured, which you can do either. I have people I can recommend to you, or Alex can help you secure it as well.
Yeah. I wouldn't stop networking either. I would still,
Right.
talk
Mhm.
to other people, let them know you got something coming up just so you can have backup. But yeah, we definitely could
Sure.
help you on the hard money side.
Good. Thank you, gentlemen,
Yeah, man, of course. I said I hope that helps.
very
Of course,
much.
you're welcome.
Like you said, Alex, that's right in your wheelhouse. Good fix and flip.
Yes, there you go.
I think like I said, I think that's a solid one. I think he shouldn't have any problems getting funding on that.
I don't think so either.
So let's what else are you doing on, or what have you guys been seeing on the acquisition side? Are y'all, what kind of deals are y'all trying to take down right now? What's your buy box? How can people on the Zoom best help you guys on that?
I think we're really trying to formulate what best works, but I would say if there's like a five or 4 or 5 bedroom, 2 bathroom, 1600 plus square feet can work more better as a co-living.
Yeah,
And we
something
like,
that ideally would pencil out for a pad split.
correct.
Because
Yeah,
Sharon
so
Lee's
we're
on
just,
here and she's a badass wholesaler. She's over in the DMV area.
well, that's perfect. Yeah, we like the Sunbelt states. So Texas is definitely one of those. I like. You said she's in the DMV.
Yeah, DC,
Yeah,
Maryland.
my partner's actually out in Baltimore. He's there too, so it works. Yep.
Sorry, she's about as fun as the DMV. Like I doesn't like being called out like that, but it's all right.
I would say I also like the Midwest too. They do have like good cash flow for the most part.
Yeah, they've got very good median house prices too. The
Yes.
Midwest and the South in general have very good median house prices. We were talking about that because like here in New Orleans, they've got I think our median house price is like 260. And a buddy of mine who's in St. Louis, like where he's looking at, I think the last deal he just locked up, he locked up for like 75.
First position.
Yeah, it was first position. It was some little town outside St. Louis.
Sharon is in two places at once.
Yep. That's what makes it even more fun to give her shit. Because then she can't say anything about it. Yeah, Sunbelt's interesting. Texas is nice. The only thing about Texas, and I'm sure you've seen this too, is the property taxes make it difficult for them to cash flow for a period of time.
Yeah, and I hear the insurance is going up there as well. Yeah,
Depends on the
Texas
part of
and
Texas.
Florida.
Yeah, it just depends on the part of Texas, right? Because like Central Texas is definitely not nearly as flood prone. Um, I did have somebody that we were doing a raise for that they had a deal in San Antonio and their insurance quote was insanely low. It's like 650 or 750 for the year. But again, that's not Houston, that's not Corpus Christi,
Yeah,
where they are much more likely to be flood prone because like as we saw, they just got hit with Hurricane Beryl like last week.
right.
So insurance does make it difficult. Taxes definitely make it difficult. Do you know roughly what you'd have to lock up a property for in Texas to offset the fact that their property taxes are as high as they are?
That I'm not too sure. I definitely have to look more into what the taxes look like. And I know even like I want to say Fort Worth, they're having sanctions against co-living or the pad split too. So that's
I
another
don't
thing to have
know.
to look into.
I don't know because I've seen a lot of co-livings and pad splits popping up in DFW, so I'm not totally sure. But I only asked that because I don't know either. I know that the taxes there are really high since Texas as a state does they don't have like sales tax. And I don't
Right.
think they have a state income tax either. So it's all like lumped into their property taxes. But I asked because I imagine, right, there's got to be a certain number that you could hit if you just go low enough below the ARV that it will automatically cash flow.
Yeah, I don't have the numbers for that one particularly yet. So if you do find out, definitely let me know before I do.
Actually, Bree's in here. Bree, if you have if you're in a place where you can come off mute, you mind talking about it? Because you just self-funded a deal in Texas that cash flowed as LTR.
Yeah, what was the question? Because I heard the insurance quote, and you're right about the insurance quote. Well, here's the thing. So I just got I have two insurance quotes on a single family home, 3 bed, 2.5 bath, not in a flood zone. And one quote was like in the ballpark of 700, and the other quote was in the ballpark of 2,400. So vastly different there. Coverage was relatively almost the same.
I guess the question to you, Bree, would be like, how low would you have to go below ARV, or how much equity would have to be available in that house for it to cash flow as an LTR with their taxes being the way that they are in Texas?
Well, the property I just acquired, so the PITI is 1588, and for its LTR is almost 1700 as an LTR.
Got it. Yeah, so But didn't you say you had equity upon purchase, right? So that's
I
PIT probably
some,
low because they were paying it
yeah,
down.
there was some equity put into it, but then also remember there were two liens on it. One of the liens is going to drop off. The other one was it's like mortgage assistance. It was like 16K. But you're right, because the ARV was around 190, 200, and the remaining mortgage balance right now is at 155.
That makes sense. Yeah, because that was what I was thinking, that you had equity in it, and that that allowed you to kind of have that PITI reduce a little bit.
But you know what? When I ran the numbers, because at one point I was like looking at possibly doing a wrap when I was having my moment. I think you know this. The homeowners didn't even put any money down. They couldn't have, they really did. I don't think they even put any money down, actually. That PITI is actually kind of high for that house.
I don't know, maybe it was just in the right area then, you think?
Yeah, I mean, yeah. I mean, it's a 2019 build. I think it's, you know, it's a good location from where it's at.
Could
I
you
think
pay off the down payment assistance and then lower the
Oh,
PITI? Is that an option?
You know what? It wasn't a conversation that we had. It was 0% interest on it. My understanding is that it needs to be, that'll get paid off. Well, you can pay it off at the refi or sale of the home. Property was in arrears, so I got that up current. But no, I didn't look at paying off the lien.
Is there a balloon on it? Or
No,
it sounds
No.
like a good deal then.
yeah, so it wasn't in a rush. Like I used to throw another $16,000 at it.
How's it working out for you now, Bree?
You know what? It's fine. I'll tell you, someone wants to come in and partner with me on the deal. So I'm probably gonna give up equity for it, which is fine. Actually just had a conversation with her this morning. Thank God she wants to partner with me because she has some ideas that I'm seeing dollar signs for. So I'm like, things that I wouldn't necessarily maybe put money into, but I mean, at the end of the day, you know, I'm just getting her input and we'll meet, you know, we'll find the common ground.
And you're still gonna do co-living with it?
Yeah. And we're gonna add a bedroom. And I have a property manager too. I think since the last time I talked to you, I didn't mention that. But yeah, I have a PM for it.
Nice.
Yeah. They're reasonable and yeah, so that's where we're at.
Yeah, I hadn't talked to you since I called you to check on you after you had your moment.
I know. Well, I was in REI conference and I've been sick all this week. So, but yeah, we can catch up this week.
We'll definitely have to.
Yeah.
I was gonna say Alex Breed's also a PML too, so I feel like that kind of played to her advantage because she knows definitely how to underwrite a property very well, and she was able to get this one, sounds like, for the right price.
Yeah, it was good. I think I could have gotten it a little bit better, but you know, it's always how it is, right?
Well, yeah, you always find a better parking spot when you're walking to the store.
Yeah, exactly. Exactly. In hindsight, I'm like, yeah, I could have negotiated this a little bit, but no, overall, it was a good deal.
Yeah, she had a little bit of a moment because there was some unplanned rehab that was discovered, I think, that wasn't in the pictures.
Yeah, and like birds in the house. Okay. I don't even think I talked about that. But like birds, okay. They like
Wow.
took the and dryer, which was fine to be expected. It wasn't included in the contract, but there were baby-ish birds in the dryer vents. And then one day, the last day I was there, they were flying around in the laundry room.
They have a whole nest.
Well, and then a vendor was at the house this week, and the property manager calls a vendor, calls me and says, "Did you know there was a cat in the house?" And I'm like, "No, the only two people have the lock coders, you and myself. So one of your vendors left the door open." I'm like, oh my God. Like a zoo in there.
Sounds like Sylvester and Tweety Bird are having a good time while you're not there.
Oh, you know me, I don't do all that stuff.
Yeah, I know you don't, but you'll be all right.
I sucked it up, put my big girl pants on.
Yeah, well, you did it. And like I said, you self-funded it too.
I did. I know. Listen to me. I'm like, I know. Well,
might-
see, you have experience on both ends of it, right? PML, PMP, self-funding my deal. Now I'm like, well, we're just gonna find partners for this stuff.
Yeah, or find me to help you help hold your hand so you don't have a panic attack.
I just had a lot of anxiety. I wasn't expecting that. I thought it was more turnkey than, what it was. I mean, it clearly was very lived in for a 2019. And it was like very eye-opening to see how like some people can live. Like,
That too. I think that's always eye open.
yeah. So anyways, we're over it. We're moving on.
Yeah, you're doing good.
Yeah. Thanks for having me.
Of course, always glad to have you, dude. You know that.
Yeah, thank you.
Is Texas your primary market, Sabrina?
Right now it is. I'm looking at Florida too. I have family in Texas and I'm trying to actually buy a home myself in Florida. So I figure I'll just go where it's familiar. But I'm originally from Chicago and I lived in New York and now I'm in PA. So I'm all over the place.
That I understand.
I heard your
Well,
comment.
taxes are high in Florida.
Oh, for you too. Ohio's a good market. Is that
No, I
what you
said
said?
I meant insurance is high in Florida is what I meant.
Oh, high in
Sorry.
Florida. Yeah. 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 But
What,
when Chicago and New York, things are cheap, okay? Ignorance is over here.
yeah, nothing's cheap in
That's true.
Chicago and New York.
New York. I'm like, everything's a deal to me. Just kidding.
No, I understand. I went from one place to the other, New York to California, so everything else in between looks nice.
I know. It's like you hit the jackpot.
Well, yeah,
Yeah.
you might as well. Like all those flyover states in between Alex's two moves, they like so the median house prices there are way or vastly different than what he's used to.
Where's that? Where
Exactly.
you?
From New York to California, I'm in Los Angeles now.
Got it. Where in New York were you?
Like Long Island, and I also lived in Brooklyn.
Yeah, I was in Long Island City. Brand new building, high rise.
There you go.
Yeah, it was nice.
Expensive for no reason.
Back, hey, corner unit in the city.
I think that's just
Mhm.
the whole state of New York. It's just expensive for no reason.
Yeah, that's true.
I lived in Westchester County for a year and I was like, I don't even know why I did this.
Yeah, that's expensive. There's some nice houses out there though.
Yeah, I was right there in Irvington on Hudson, which is like one of those little bitty villages
Huh.
that's like along the way, like Dobbs Ferry and Tarrytown and all those.
Mhm.
Well,
But yeah, I'm sure that both of y'all, like houses in any other market, you could probably get two for the price of one.
more like 3. Like,
Is that true where you're at too, Alex? You could get almost 3 houses for the price of one compared to LA.
And that's how I feel.
Damn, dude,
Yeah,
that's
it's like close to $1 million and for like a 2-1 in certain places. So yeah.
fuck. I
But
saw
out of
that
state investor.
we had some Austin deals to dispo that were like that, and I was like, dude, who in the fuck is paying? It was like $1 million for like a 3-2. I was like, who's paying this?
a
And
lot of surprisingly.
I guess that's my answer is it's all the Californians that moved to Austin. That's who's paying for it.
Oh, and you got the New
There you
Yorkers.
go.
I mean, a lot of New Yorkers are actually, well, during the pandemic, they moved down to Florida. Now a lot of them are going back to New York, actually.
Yeah, but New York's always kind of just treated Florida and like the Carolinas as their retirement village anyway.
Yeah.
I found that out. We went on vacation to Myrtle Beach with my girlfriend at the time, who was from New York, her and her family. And everywhere we drove around Myrtle Beach, it was all New York license plates.
Interesting.
Absolutely wild.
Yeah, everyone tries to retire in Florida.
Well, they get sick and tired of the snow. And I don't blame them. That shit's a logistical nightmare.
Yeah, great to visit, but it's a different story to live in.
Yeah, like we have water. I can drive through water. I can't drive through ice. Any other big projects you're working on right now, Alex? Or is it just getting acquisitions up?
Nothing. Just getting the back end for ours working out. Um, our next steps is operations manager, filling that out, and then we're gonna start branching out.
Well, dude, if you need any help with the systems or the processes, let me know. Because like I said, we have the integrator team too.
I do actually. I'm definitely interested. I've been playing around with even your calendar. You're using Motion, right?
Yeah. Yeah, I've been using Motion. It's been nice because I integrate like 5 different calendars into one and they're all color coded and everything. So I know what's what and where I have to be. All I do is show up.
That makes it simple.
And it keeps all my conferencing details saved. So then that way, like if this was a scope call and we're doing an immediate follow-up call, I just go straight to my calendar. I just start typing in Alex and then it usually will pull up like Alex Angus. It'll pull up your email address, click it, and then hit create event and you've got the calendar invite in your inbox in like 3 seconds.
Nice.
So yeah, but if you ever need help on that, just let me know. We'll definitely get you set up. Like so Ryan, Love, and I are combining forces to get the integrator team moving.
Okay. Yeah, I'm interested.
But yeah, man, like say any other big projects, any kind of parting thoughts that you wanna or parting wisdom?
I don't know that I have a lot right now, but I mean, I heard from Ron that he's got, his deal going, and I would say probate lawyers are actually a great strategy for leads. So those are great for acquisitions and actually trying to find creative deals too. So maybe keep a lookout on that.
Yeah, I would say definitely probate, foreclosure, pre-foreclosure can be a little bit inaccurate at times, but probate's pretty much always accurate. Um, but yeah, man, I mean, like I said, this has been good. I think a lot of people are gonna get a lot of value from this one. And all I can say is guys, y'all know that we try to put these Zooms on every Sunday. So if we made you think, if we made you laugh, if we brought you value, if this was helpful to you, just do us a favor, come back next week and bring a friend. So, oh, and Alex, before we do go, where can people find you if they do want to reach out to you, whether they have a deal or that you for your acquisitions team or they need help with getting funding?
On my numbers on the screen, you can reach me at my cell, 718-219-9382. I'm also on Facebook. You can just reach me at Alex Angus.
Good deal, guys. He's an awesome connection to have. Alex and I have had some good conversations over the past couple of months, and definitely look forward to bringing him back and doing this one again. So, like I said, if we brought you value, if we made you think, if we made you laugh, if we made you smile, if you think this is valuable, all we ask is for you to come back and bring a friend. So until next time, guys.